holding with the 90-point gain as we speak. But I think if you're looking for a bit of a niggle, from the auto space, there is Tata Motors that's moved a little lower. And I think we have even Bajaj Auto that's moved into the red. So a couple of those stocks, they're seeing a bit of a downtick in the last few minutes. But as promised earlier today, Lata Venkatesh spoke to Sanjeev Sanyal. Let's hear out that exclusive conversation.
So the world, as we look forward into it, yes, certainly there are a lot of uncertainties. But on the other hand, some things have also flowed our way. For example, oil prices have come off a long way from when they peaked in October, November. If you remember, they were at 85. Now we are looking at 53. So much better. Yes, there are some apprehensions about the world economy slowing down. But on the other hand, remember, the US Fed has suggested that it will probably tighten somewhat at a pace that's somewhat less steep than had otherwise been, which, by the way, is very good for us because it means that the global liquidity conditions of anything will be somewhat easier than we had earlier anticipated. There may still be some tightening, but much easier than people had anticipated earlier. Yes, of course, trade wars make things uncertain. But again, as I said, not entirely gloomy. I mean, there are areas where if we in India, look at it positively and try and find ways in which India can, insert itself into a new global supply chain that may be emerging out of these trade wars, then in fact we can take advantage of it. So I would argue that yes, there are some challenges, but there are many areas where, in fact, India can take advantage of the situation, from lower energy prices, somewhat easier global interest rates, and perhaps a liquefied global supply chain where we can insert ourselves. So, and many other things as well. So I think not really such a gloomy picture of the world as maybe somebody else would have told you.
The most immediate news that we are getting is that the fiscal deficit is now 114% of the full year budget. It normally tends to be higher in the months of November, December, and gets corrected as advance taxes come in the last quarter. But nevertheless, it's a slightly higher number than we are used to as early as November. Plus, we hear that the government is planning some kind of a farm support, maybe a basic income, maybe a waiver, maybe some way of supporting farm prices. It does look like fiscal deficit is going to get much bigger than we thought.
Let me just clarify that we continue to remain very much committed to fiscal consolidation. So we are not, contemplating moving away from that commitment. As far as the farm sector is concerned, I think we need to be clear that, you see, what is the issue that the farm sector is facing? In the past, the problem used to be for drought or floods or whatever, weather-related factors, we used to be a shortage country. Now what has happened, ironically because of our own success, in fact, in increasing farm production, we have ended up in a situation where we are producing a lot more food than we could possibly consume.
Like you said, that we've got a severe food disinflation, which has actually been surprising. One thought that MSPs would perhaps increase the prices. That has not happened. And now to add to that, we also have a fuel disinflation. So what do you look at in terms of, how much rate cuts can come? We already have a fairly comfortable liquidity with the Reserve Bank promising 50,000 crore of bond purchases December, Jan, Feb and March. To add to that, how much space for rate cuts do you see in 2019?
Firstly, let me clarify that this is really the prerogative of the Monetary Policy Committee. So I can't comment on exactly how much they should cut. But I can lay out the landscape. Basically, inflation is now running at the bottom of the range that the Monetary Policy Committee had been given. And we have now, it's just not something new, we have now had for some time inflation running at or below the midpoint of that range. So inflation, I think, has structurally come off. I think it's fair to say that the old 7 or 8 to 10% range of inflation that we used to have, that has been lowered by some good, 500-600 basis points. So if that is the case, we need to see a commensurate reduction in the nominal interest rates. Otherwise, you have real interest rates running about the highest in the world. I mean, small business still borrows at 12 percentage points, right? Now, if inflation is running at 2%, that's 1,000 basis point real interest rate. Clearly, 1,000 basis point, at least an 800 basis point real interest rate for large parts of the economy. This is clearly not tenable because of a variety of reasons. First of all, this is a source of enormous financial stress to the balance sheets. So this is a major problem for small business, large business, for farmers. After all, farmers can also be seen as small business, and so on. It also causes stress on our fiscal side because the government is, after all, the biggest borrower from the system. So it is a stress on the fiscal side. But also, ironically, keeping high interest rates over long periods of time also increases inflation. This is something that economists tend to forget, that while high interest rates in the medium term lowers inflation, in the long run, high interest rates mean that you do not build capacities that you would have otherwise built, whether infrastructure, in industry, and so on. So you end up with higher supply side inflation in the long run if you keep interest rates high indefinitely, irrespective of where inflation is. So I think we have structurally brought down inflation. We now need to take step 2 and structurally bring down the interest rates so that they are in sync with the new level of inflation.
Okay, we'll slip into a very short break on that note. As a part of our Rewind series, we've been getting you a roundup of how different sectors have fared in 2018. Up next is a wrap on the real estate sector in the year gone by. Stay tuned.